Most modern economies operate under a simple assumption of control. A nation prints its own currency, its central bank sets its own interest rates, and therefore it dictates its own economic destiny. But that domestic independence frequently collides with the sheer mass of the U.S. financial system. When U.S. officials adjust inflation targets and interest rates, they are solving entirely for the American economy. Yet, because global finance is so deeply wired into the dollar, those rising Treasury yields immediately tighten financing conditions everywhere else. Higher yields make American assets incredibly attractive. The reaction is a sudden reversal of global capital, draining out of emerging markets and rushing toward perceived safety and higher returns in North America. Countries absolutely control their own interest rates, but they do not control the broader financial conditions that actually shape their economies. Every domestic decision happens inside a dollar-centric network. The simplest way this pressure spreads outward is through global trade. Many vital commodities, particularly energy, are priced universally in US dollars. Suppose the global price of a barrel of oil remains completely flat at $100. At the exact same time, a developing nation sees its currency weaken by 10% against the dollar. This animated diagram shows the purchasing math at the border. On the left, the cost of oil stays perfectly flat. But on the right, because of the weaker exchange rate, the local cost to import that exact same barrel instantly spikes. Scale that math across everything a country brings in, from heavy machinery and electronics to agricultural fertilizer and medicine. The cost of all these goods goes up, pushing local inflation higher even if domestic consumer demand is completely stagnant. Nothing changed about the actual goods, and nothing changed about the local appetite for them. These emerging nations are effectively importing inflation directly through the exchange rate. That inflation pressure forces local central banks to react, but they are simultaneously watching foreign investors pull capital away, favoring the predictability and higher yield of U.S. assets. This creates an incredibly difficult dilemma for policymakers. They can drastically raise their own local interest rates to attract capital and defend their crashing currency, or they can lower rates to stimulate their struggling domestic growth. Choosing one path destroys the other. You cannot defend the currency without crushing domestic expansion, and you cannot boost growth without letting the currency collapse. When they inevitably choose to defend the currency to stop inflation, a clear feedback loop locks in. This flowchart illustrates the cycle. Higher U.S. yields trigger capital outflows. That weakens the local currency, which forces the local central bank to keep their own rates tighter for much longer. The stronger the relative return and stability of U.S. assets, the higher the baseline cost of economic survival becomes for the rest of the world. Beyond trade and interest rates, there is a third, structurally dangerous channel. Many foreign governments and corporations hold debt denominated in US dollars, a currency they cannot print and do not control. Take a standard corporate example. A company operating outside the US takes out a $1 billion loan when exchange rates are perfectly stable, locking in a predictable liability in their local currency. Then the local currency weakens. This diagram illustrates the impact on a balance sheet. The actual US dollar debt on the left remains static at $1 billion. But because the local currency lost value, the effective local liability on the right drastically swells by 20%. The company's repayment burden just became devastatingly heavy. They didn't borrow a single extra dollar. They didn't change their business model. The debt simply grew because the dollar strengthened. Global finance is interconnected asymmetrically. The dollar sits at the center, allowing the United States to export its monetary tightening straight into foreign corporate balance sheets, regardless of local economic conditions. When central banks are forced to maintain high rates to defend against these pressures, the effects quickly bleed out of the data terminals and into daily life. The defensive measures required to stabilize a currency immediately begin to suffocate local commerce. For households, the cost of borrowing stays elevated. Mortgages become unaffordable for average buyers. Consumer credit dries up, causing retail demand to slow down or freeze entirely. For businesses, the cost of capital becomes too high to justify risk. Small manufacturers postpone expansion plans, halt purchasing equipment, and stop hiring new workers. Exchange rates are not abstract market variables. A policy decision originally intended to defend a nation's currency eventually acts as a direct limiter on household consumption and job creation. The world economy may appear increasingly decentralized and multipolar in geopolitical terms, but structurally, global trade and finance still revolve entirely around one unipolar anchor. This system is held in place by powerful network effects. International investors and governments trust dollar liquidity simply because everyone else trusts dollar liquidity. It is a deeply ingrained architecture that remains highly resistant to replacement. And that creates a dangerous paradox. Over the last few decades, emerging economies have become the primary drivers of incremental world growth. If the persistent weight of the dollar forces multiple emerging markets to slow down simultaneously, global demand itself weakens. That drop in international trade eventually boomerangs, bleeding back into U.S. exports, earnings, and financial markets. Emerging nations no longer have the luxury of just managing their own domestic conditions. Their primary task is managing their position and their survival inside a dollar